Is now starting. All attendees are in listen-only mode.
Hello, everyone. Thank you for joining today's webinar, Tariff Uncertainty in Higher Education in Virginia. This presentation is being presented by Dr. Bob McNab. I have a couple brief logistical reminders for everyone before the presentation starts, and then I'll hand it over to Dr. Peter Evangelakis. First, I want to remind everyone that about an hour after the presentation concludes, a copy of the slides and a recording of the presentation will be shared to you through email. If you have any questions once you get a closer look at these materials, please reach out to us at info@remi.com, and I would gladly connect you with Bob. I also want to encourage everybody to enter questions that they have during the presentation into the question box. Time permitting, Dr. Evangelakis will moderate these questions to Dr. McNab following the end of his presentation. I will now pass it over to Peter.
Thank you very much, Brian. I'd like to welcome our speaker for today, Professor Robert M. McNab. Currently serves as the chair of the Department of Economics and director of the Dragas Center for Economic Analysis and Policy in the Strome College of Business at Old Dominion University. He is a member of the Federal Reserve Bank of Philadelphia's Survey of Professional Forecasters and is an associate editor with the Journal of Economic Surveys. Professor McNab has published in Applied Economics, Cornell Hospitality Quarterly, Defense and Peace Economics, National Tax Journal, Public Budget, Budgeting and Finance, and World Development. From 2018 to 2022, he was a member of the Joint Advisory Board of Economists for the Commonwealth of Virginia. He edits the annual State of the Region, Hampton Roads, and State of the Commonwealth reports. And Professor McNab has appeared in the Associated Press, China Global Television Network, CNN, Newsweek, Wall Street Journal, Washington Post, Yahoo News, Yahoo Finance, the Richmond Times-Dispatch, the Virginian Pilot, and Daily Press, among others. Dr. McNab joined the faculty of the Department of Economics in the Strome College of Business of Old Dominion University in July of 2016, and was previously a member of the faculty of the Naval Postgraduate School in Monterey, California, from 2000 to 2016. And just before I turn it over to Bob, ODU and Bob's team have been a client of ours in the past, and we were very happy to support their work, and we'd be glad to in the future. And over the past several years, it's been our honor to host this State of the Commonwealth webinar each year around this time. And we certainly look forward to hearing what you have to say, Bob. So with that, I'll turn it over to you.
Okay, thanks, Peter. And I assume everybody could hear me and see my slides. And since I'm not receiving any pings about no slides or no voice, let me get started. Once again, my name is Bob McNab. I'm the chair of the Department of Economics and director of the Dragas Center for Economic Analysis and Policy here at Old Dominion University. And I would like to thank Peter and Remy for hosting us once again on what one might characterize uncertain times. I'd like to start by saying anything I speak about today and my opinions and commentary are my own. They don't obviously represent viewpoints of the Federal Reserve Bank of Philadelphia, the Commonwealth of Virginia, Old Dominion University, the Strome College of Business, or our donors. I'm happy to engage if you have questions about the comment. Feel free to reach out to Remy, and they'll put you in touch with me, or fairly Googleable also. I respond best to email, mainly because it's hard to track me down sometimes. Too many meetings given too many hats. So let's start off by caveating today's discussion by discussing uncertainty. So we are currently nearing the end of March. We are starting to get the first inklings of data with regards to changes in immigration and trade policy and federal spending and employment policy. We have to recognize that much of the data in today's presentation, which is lagged, is going to trail events. And so much of this is actually about where we were and where we potentially may go. I think the word of 2025 is likely to be uncertainty. And unfortunately, recession has crept into the vocabulary yet again. And whether or not we can avoid a recession, given the significant changes to immigration, trade, and spending and employment policy at the federal level, remains to be seen. So let's talk about where we were. And one way to think about where we were is to look at gross domestic product. Now, gross domestic product obviously is a measure of the value of final goods and services produced in the United States. It is a measure of economic activity. We will see first quarter GDP come out shortly after the end of the quarter, but again, it will likely not fully capture the impacts of changes in federal spending and employment policy. And then any trade effects will obviously be further along the timeline. But if we think about where we were in 2019, we were at the end, and really, which ended in February 2020, the longest peacetime expansion in U.S. history. And of course, we had the COVID-19 pandemic economic shock in 2020, in which led to significant declines in gross domestic product, real and nominal, and the most significant contraction in the shortest period of time observed in that over the last century, including the Great Depression, and then a relatively rapid recovery from the pandemic economic shock, with growth resuming and continuing to a large part through the end of 2024. Of course, one of the phenomena that we did experience coming out of the pandemic era economic shock, and we'll talk about more in detail, was the spike in inflation. And of course, that represents the divergence between the nominal GDP numbers in blue and the red GDP numbers in red, which are based in 2017 prices. If we look at Virginia, and being based in Virginia, this is kind of the lens we look at things through. We saw that Virginia grew as well following the pandemic economic shock. And Virginia's growth has been more robust following the shock in 2020 than prior to. And in fact, for some areas of Virginia, for example, I live in the Hampton Roads area. That's where ODU is located in southeastern Virginia. The decade prior to the COVID-19 pandemic shock was one characterized by one of loss, that the economy of the region largely did not grow over those 10 decades. And so if you think about Virginia, and you think about Virginia consisting of Northern Virginia, Richmond, and Hampton Roads, that is defined as the urban crescent. And what we've seen over time is that economic activity and the population of Virginia has become increasingly concentrated in the urban crescent, defined by Northern Virginia, Richmond, and Hampton Roads, and increasingly concentrated in the urban crescent between Richmond and Northern Virginia, which is of increasing importance given the changes in federal spending and employment policy. So Virginia has had a relatively good, as one might argue, 4 years, and that has resulted in an increasing amount of monies flowing into the public coffers and debates about what to do with the public surplus. We'll loop back to that shortly. So if we compare the performance of Virginia in the United States by indexing both economies to 2000, we can see that the Virginia economy actually outperformed the national economy up to and through the Great Recession of 2007-2009. However, in the resulting economic expansion from 2010 through February 2010 through February 2020, you can see that the Virginia economy did grow, but it actually was eclipsed prior to the pandemic by the performance of the national economy. Some of this has to do with budget sequestration as a result of the Budget Control Act of 2011, and actually the sequestration of discretionary expenditures in fiscal 2013 and the subsequent modifications of spending caps moving forward. That's no longer an issue for federal spending. However, the first years of the previous decade definitely were less than desirable for the Commonwealth because of the drag on increases in federal spending that power in part the Virginia economy and in large part the regional economy where I'm based here. Coming out of the pandemic, you can see really the performance of the Virginia national economies as mirrored each other, that they have grown very much at this same rate, fairly indistinguishable. So whatever gap there was prior to the start of the pandemic has largely disappeared. And in accounting for statistical noise, the two measures of performance are essentially equivalent. If we look at this through a lens of civilian labor force and employment, we have to remember there's two broad measures that we look at in terms of job markets. The first measure is one of individuals. It is the civilian labor force and individual employment, where there's a monthly survey that is conducted of individuals asking whether or not individuals are employed or looking for work in the reference week of the survey, and whether they're employed in the reference week of the survey. And similarly, the establishment survey, which measures non-farm payrolls, asks employers a similar question about the number of jobs they have. So this is a measure of individuals. And one can see here that the shock to employment from the pandemic was more significant than the shock to the civilian labor force. So thus, many of the individuals who experience unemployment did not decide to leave the labor force, and the impacts on civilian labor force participation were relatively transient, to use the word of the day. And you can see that we have observed a continued growth of the labor force and individuals reporting they're employed post-pandemic. And this is something that was surprising to many economists for 2024, where there was an initial expectation at the beginning of 2024 of a weakening of the job market due to a variety of factors, including an expectation that inflation would remain much more persistent at higher levels than it actually was, but also that in the face of higher interest rates, consumers would slow down spending. And what we have observed, that consumer spending has remained relatively resilient even with higher interest rates, and that individual employment and civilian labor force numbers have remained remarkably resilient in the face of that as well. And so if we looked at the number of people reporting in the labor force, roughly 6 million more people were in the labor force in the latest data in February 2025 compared to the pre-pandemic peak. And you can see that individual employment had increased as well, which suggests that even through February 2025, the national economy continued to expand from an individual employment and civilian labor force perspective. When we look at Virginia, we see a somewhat different story initially in terms of the recovery. Yes, we see a decline in individual employment and civilian labor force that mirrors that of the United States, but the recovery in the civilian labor force for Virginia was much more tepid initially than nationally. You can see from its lows in the spring of 2020, the civilian labor force was relatively stagnant. While it did recover some in the summer of 2020, it then declined again, did not reach the pandemic lows, but definitely did not grow. And it really wasn't into the second half of 2021 we saw the civilian labor force start to recover and finally eclipsed pre-pandemic levels in 2022. Now the civilian labor force is larger than it was prior to the onset of the pandemic. Individual employment has grown as well in the state. So for Virginia, what we have seen is that the recovery of the civilian labor force really begins in earnest in the latter half of 2021 and picks up steam, as one might say, in 2022, and then levels off in 2023, while individual employment grew steadily from the trough observed in the spring of 2020, and its growth then moderated in 2023 to match the growth pattern of the civilian labor force. If we look at non-farm payrolls, recognizing that the non-farm payrolls come from the establishment survey, we again see a similar pattern, a sharp dip in non-farm payrolls coming out of the recession of the spring of 2020. We see that Virginia continues to grow in terms of non-farm payrolls as well as the United States, and the stronger than expected growth than we forecast at the beginning of 2025. So if one thinks about the conditions entering the new administration, it is one of stronger than expected economic growth and labor market performance in the latter half of 2024. In my forecast presentation in January 2020, one of the best case scenarios I could argue is that an incoming administration would largely leave immigration and trade policy untouched and focused instead on the traditional sort of packages of looking at the tax code, especially extending the Tax Cuts and Jobs Act of 2017 and other tax extenders and tax cuts. And that would sort of build off the existing expansion in the U.S. economy. However, that is not the case, as we'll talk about in a moment. One way to think about this is to place the 2020s in context. And we could use the average unemployment rate in the United States and Virginia by decade to do this. If you look at the average unemployment rate for the 2020s, which includes the COVID recession and recovery in 2020 and 2001, the average unemployment rate in the United States this decade has been 4.9%, which has been lower than any other decade since the 1970s. And the same applies for Virginia, which is an illustration that we've had an economic expansion post-pandemic, even with relatively tight labor markets. And that has meant that employers have been increasingly challenged with regards to finding the right employees at the right time. And even in that environment with relatively tight labor markets and real wages growing faster than inflation, we've seen significant job expansion even through the end of 2024. So the national and state economies were sort of primed for growth in 2025, even with underlying inflationary pressures that continue to be resistant with regards to the Federal Reserve's attempts to rein in inflationary expectations through a reversal of quantitative easing or quantitative reversing, which they have called, and higher interest rates. So let's talk about the sort of macroeconomic phenomenon that dominated the conversation from 2021 onwards, and that was inflation. And if we think about inflation, we can observe two things and two measures that are informative. One is the headline rate of inflation, and one is the core rate of inflation, which excludes the food and energy sectors. We know that food and energy are significantly more volatile than other components of the inflation measure, which is derived from this year-over-year change in the consumer price index. And if we pay attention to core inflation, that core inflation hovered around 2% for most of the previous decade. And so from a monetary policy perspective, monetary policy was, well, one might say, relatively straightforward. The economy was not experiencing price pressures. The Federal Reserve often found that on average, the personal consumption measures index illustrated a rate of inflation that was at or near the 2% target. That relative stability in prices allowed the Federal Reserve to engage in quantitative easing, which is essentially buying securities. And by doing that, you increase the money supply in an attempt to boost employment. And actually, when the Federal Reserve tried to raise the discount rate in the second half of the decade, equities markets did not like that, and it never got higher than, I believe, 3.5%. And the Federal Reserve was actually moderating its monetary policy stance up until the COVID-19 recession, at which it engaged in an aggressive monetary stimulus to corresponding with the massive fiscal stimulus, which I think we could all agree definitely stayed off the worst impacts of the COVID-19 recession and promoted the recovery. But of course, when you significantly increase the money supply by approximately 25% in the span of 12 months, and you couple that with significant amounts of fiscal stimulus and supply chain shocks, it should not be any surprise that you have a resulting inflationary spike, which is what happened in 2022. To paraphrase Milton Friedman, inflation anywhere and everywhere is a monetary phenomenon. We could also add that it's a psychological phenomenon, which we'll talk about shortly. And so the head rate of inflation reached 9% in 2022 and has declined since then. And through February 2005, we've seen the core rate of inflation decline to 3.1%, and the headline rate of inflation decline to approximately 2.8% in the last month of observation. So we have to be careful that individuals who are saying we've seen the core rate of headline rate of inflation decrease in the last observation, they're entirely correct. But 1 month does not make a trend, and this we'll really have to remember that inflation is a lagging indicator also, that when policies are announced, those policies, whether they're fiscal or monetary, take a while to wind their way through to prices. And so if one is expecting to see price impacts of tariff announcement, those are forthcoming. The uncertainty regarding tariff announcements is already present, but the actual price impacts as those tariffs are put into place will show up in consumer prices over the coming months. One way to also think about inflation is to step back and think about what consumers are experiencing. Because if you tell consumers that inflation is down, and look, it's been decreasing since its high of 2022, I'm sorry, if we go back in 2022, then consumers will respond, I'm not seeing that. In fact, prices are continuing to increase. And they're exactly right. We often say monetary policy is success because it's lowered the rate of inflation, but just because the rate of inflation is lower doesn't mean that consumers are experiencing lower prices absolutely at the grocery store. And from the consumer's perspective, what they often deal with is the cumulative effects of inflation. That is the additive effects over time, vice the year-over-year change, which is measured by the headline rate of inflation or the core rate of inflation. And so from the consumer's perspective, on average, we've seen prices increase by more than 25% since January 2029. And you feel that in a psychological sense, when you walk into the grocery store and you used to buy a 12-pack of soda, for example, for $3, and now it's $6, which is more than 25%. But again, CPI is an average measure. And psychologically, you feel poor. And that is a difficult phenomenon to align by a behavioral perspective. But we also have to recognize that volatility is an important part of the discussion also. I'd like to start by starting at the left-hand side of the graph and moving to the right-hand side of the graph. So average inflation by decade, in the 1960s, we could see that core inflation was approximately 2.5%. In the 70s, core inflation rises on average to 6.5%, and it's actually fairly persistent in the 80s at 6.1%. And then we see the 1990s, 2000, and 2010, we see both measures of inflation decline. So from a consumer's perspective, looking backwards, if you're old enough, people talk about how difficult the 70s and early 80s were because of rising prices, because of economic uncertainty, because of if you remember, the Federal Reserve increasing the discount rate significantly in the early 1980s to break inflationary expectations. And so from that perspective, if you were sitting in the 90s, 2000, or 2010s, you look back and go, those were turbulent, uncertain times. However, we're living in a period now, especially in the 2010s, where inflation seems to be under control and fairly predictable. If you have grown accustomed to that environment, then seeing inflation increase such the average rate of inflation goes from 1.8 in the 2010s to 4.2% in the 2020s is a psychological shock that affects your behavior and spending, which then in turn affects the overall economy. And one way to think about this is to look at the variability of inflation. We can use a measure called the coefficient of variation. The coefficient of variation is equal to the standard deviation divided by its mean. In other words, the spread divided by the measure of central tendency. Why is this important? Because consumers don't like variability, I would argue. They prefer stability in prices. And so if prices are relatively stable but higher, consumers are more and businesses are more able to adapt to that than prices that go from significantly higher to significantly lower inflation and are less predictable. So if we look now at the 90s, 2000, and 2010s, and we look at the coefficient of variation as a measure of variability, in other words, the variability of the inflationary series relative to its mean, you can look at the red line in terms of core inflation. You could see the variability of core inflation was less in the 90s than the 80s and the 70s and the 60s, and the variability of inflation in the 2010s was less than the 1990s. So not only did the average rate of inflation decline, the variability of inflation within each decade declined. Then you see the 2020s. Even though the variation of the headline inflation in the 2020s was relatively the same as the 2000s and 1980s, core inflation, which removes food and fuel prices, you can see the variation of that was twice that of the previous 2 decades. So from a consumer's perspective, prices were much more uncertain. That is, they were varying much more significantly than the previous 2 decades. So you had a phenomenon where consumers were uncertain about what prices would be, that they were only going up. So if we look at the data and we ask consumers, and this is one of the soft measures we have of how consumers are feeling, we could go back to the University of Michigan Consumer Sentiment data. And so what I want to focus on here is what the Consumer Sentiment Index was prior to the onset of the COVID-19 pandemic. That is, it was approximately equal to 101. Its base year is back in 1996 Q1. But a measurement of 100 basically says that consumers are relatively stable in their sentiments compared to that base year. And then if it's lower than 100, you would say that consumers are becoming more pessimistic. If it's higher than 100, consumers are relatively more optimistic. And we can see as the line turns from blue to red that consumer sentiment declines by over 30 points. And it bottoms out in April 2020, as one might expect, as the April 2020 represents sort of the depths of the COVID-19 pandemic. Consumer sentiment recovers, but not as quickly as one might see, given the gains in economic activity from the recovery from the pandemic, reaches a high in April 2021, and then, to put it technically, plummets to a value of 50 in mid 2022. The value of 50 is important because it says the consumer sentiment not only was half of that of pre-pandemic, it was actually the lowest observed value since the early 1980s. So in other words, consumer sentiment about the economy in 2022 was worse than it was during the financial crisis of 2007 to 2009, and worse than the 80-81 recession. So perhaps the pandemic and social media and continuous news have broken something, but consumers are definitely feeling worse about the economy now structurally than prior to the pandemic. We see a recovery in consumer sentiment, peaks in early 2024, declines somewhat in July 2024, increases again after the election, and then we've seen essentially consumer sentiment decline significantly in February and March of this year. One reason is that consumers are expecting more inflation. So remember, the blue line here is the headline rate of inflation. The red line is inflationary expectations from the University of Michigan survey. One does not have to be an economist to look at this and see the rapid increase in inflationary expectations of 2025, as we've seen tariff announcements sort of flood the zone, as one might say. And in fact, the headline today on Bloomberg is that the president may announce new tariffs or give the schedule of tariffs for automobiles imported from other countries. These continual announcements of tariffs, even if they're retracted, start to affect behavior, that people now are increasingly uncertain about the future. They believe tariffs are going to raise prices. Tariffs will raise prices unless a good is unable to be passed through in terms of price increases to consumers, and those are very relatively rare, depending upon demand elasticity. But what we're seeing, regardless of it's the University of Michigan survey, the Conference Board came out with a survey this morning that mirrored this. We've seen Institute of Supply Management surveys. We've seen regional Federal Reserve surveys. All the surveys point to a reversal in inflationary expectations in February and into March. In other words, consumers and businesses at the end of 2024 believe that inflation would be decreasing in 25 and into 26 and beyond. There has been a significant reversal in those expectations. This is very important from the perspective of monetary policy, because the Federal Reserve is now essentially forced to sit on the sidelines because it is receiving information that they can't act upon. The Federal Reserve is getting information about tariff increases, knowing that tariff increases will increase domestic prices because they're a tax on American consumers levied on the port of entry and then passed through businesses to consumers. How much is it passed between businesses and consumers depends upon the elasticity of the good in question. So they have this piece of information that suggests that future prices will increase. They also have a piece of information now with at least 2 months of soft data that inflationary expectations are increasing and jumping significantly. In fact, the increase in inflationary expectations from the University of Michigan survey was the highest increase recorded from the late 1920s. So you have announcements and expectations data that hasn't materialized in the actual data, but you can't loosen monetary policy because monetary policy has a lag built in. So if you lower discount rate right now, what you could end up doing is getting behind the curveball again, as one might say, as happened in 2021 and 2022. And I know the Federal Reserve Chairman said that they would expect any tariff-related inflation to be transitory. The problem with that is that it ignores the psychology of inflation, where if consumers expect prices to increase and observe prices to increase, they're going to harden their expectations about prices increasing, and that's not transitory. And that would require an increase in the discount rate and further quantitative tightening. And so one of the troubling signs of the most recent announcement that shows the hard position of the Federal Reserve in is that they left the discount rate the same, but they sort of dialed back the quantitative tightening, which suggests that they believe the economy is softening, and they're making a bet that any inflation resulting from tariffs and uncertainty would be transitory. One of the things we also have to recognize, we're living in a much different environment than the last significant recession in 2007, 2009, and the previous recession that, because the proliferation of social media and 24/7 news and people essentially living in the information enclaves. What we've seen is assessments of current economic conditions somewhat mirror each other. That if we look at the most recent data, you can see that among people who identified as Democrats in the University of Michigan survey, their sentiment about the economy is significantly worsened, as one might expect after the election. But we even see Republican sentiment decline as well. So Republicans, or people who identify as Republicans in the survey, have been much more pessimistic about the state of the economy as it is today than Democrats since January 2022. However, the recent gains in sentiment by the Republicans seem to be eroding somewhat. On the other hand, we can see that expectations about conditions next year have reversed. And that reversal takes place, not surprisingly, in November 2024. And one would expect, as additional data starts to come out, that Democratic sentiment about the economy a year from now is going to decline. Republican sentiment continues to be stable, at least in the last 2 or 3 months. But if economic conditions continue to worsen, you would expect that to pull down the economy as well. So we essentially have economic momentum turning into uncertainty. Job growth continued in 2024, but labor markets appear to be weakening because businesses are increasingly concerned about a recession. The CFO survey just came out, said that most CFOs of major corporations in the United States are increasingly expecting a recession in the second half of 2025. Consumer sentiment has been lower, and it's declining rapidly. It's kind of buoyed right now by Republican future sentiment about the economy. But if that turns south, then consumer sentiment essentially could be lower than it was and then 2022. We don't have good data yet on federal spending and layoffs. I've seen a lot of announcements from the Department of Governmental Efficiency, but those have to be taken with a large grain, if not a whole container of salt, because we just can't verify that those are actual savings. If you already, these are funds that have been appropriated, that have been, and in many cases, obligated and encumbered and actually spent, so you can't claim savings on money that's already been spent. The bigger impact is going to be initially with federal layoffs and the uncertainty regarding those layoffs and the downstream impacts on services. We're starting to see already disruptions with services of Department of Veterans Affairs and Social Security. Very concerning announcement from the IRS, not the IRS, but a leak from the IRS that their projected tax revenue for this year is actually going to be $500 billion lower because of expected declines in compliance given the layoffs to the IRS. And having worked in countries with poor tax culture, once you erode tax culture, it's just extraordinarily difficult to get back. So whatever savings the Department of Government Efficiency might actually realize by laying off 20,000 employees at the IRS, they will be totally obliterated by the declines in tax revenue. And those declines in tax revenue are self-reinforcing because as people expect further declines in service and awareness by the IRS, tax non-compliance will increase. And so that $500 billion in projected revenue decline might actually become more and more significant in the future as everybody starts to realize they could cheat on their taxes and there are no consequences or not file entirely. Economic uncertainty continues to increase. I mentioned the president's tariff announcement today. These are all rumors and uncertainty, and whether things will actually start being levied on April 2nd remains unknown. So markets are continuing to bet that things are not going to be as bad as they seem to be. And when you see wild swings in the market, especially downturns, it's because people place bets that these tariffs won't come into force, and then they do, and they're having to reel back their dreads. I think growth prospects nationally are declining significantly and rapidly, and that we are approaching a self-fulfilling prophecy of a recession in the second half of the year. So let me give you some more warning signs that I am really concerned about, if concern hasn't already underlaid everything I've talked about. One of the things that we have to recognize is the federal government's fiscal house is a complete disaster. The last time we had a on-budget surplus was the early 2000s. We now have a structural deficit more than $1 trillion a year. And in fact, I remember giving presentations in the late 2010s saying that by the end of the 2030s, we'll have a structural $2 trillion deficit. And now it's like $1 trillion, that's normal. We won't really get worried about it until it increases. So the gap between outlays and receipts continues to be persistent and grow over time, which means that at the end of fiscal 24, we had a deficit of $1.8 trillion. And of course, people were going, what a success, because compared to the COVID pandemic years, that's $3.1 trillion in nominal terms. But in reality, the ongoing budget deficit in 2024 was larger than the budget deficit during the stimulus of the Great Recession in nominal terms. So we are not in a good fiscal position, and it is getting worse, which means, of course, that our federal debt through the Q4 2024 is $36.2 trillion. Some of that is held overseas, 8.5 trillion, and some of that is held by the Federal Reserve, 4.6 trillion. The Federal Reserve, as you can see, is unwinding that. That's quantitative tightening, but it has dialed that back in the face of what it expects to be weakening job growth in the United States. And so what we're seeing is that the Federal Reserve engages in significant monetary stimulus in the 2020s and trying to unwind its balance sheet, but declining macroeconomic conditions are inhibiting its ability to do that. And so if you think about $36 trillion of debt, you got to service the debt. And servicing the debt is expensive. So net interest on the debt has rapidly increased. And the net interest on the debt in fiscal 2024 was approximately $897 billion, as large as the total DoD budget, including supplemental expenditures. The net interest on the debt will be larger than the DoD budget, if not this fiscal year, certainly next fiscal year. And that's before we even talk about any potential extension of the TCJA of the 2017 and any potential additional tax cuts on top of that. And the Congressional Budget Office just reported today they believe the X date on the debt service is essentially August or September of this year. So if the debt ceiling is extended, we're facing a potential default, at least partially, on U.S. government debt. Economic catastrophe would be the understatement of the day. So we have a fiscal house that essentially is on fire, and we're continuing to pour gasoline on the fire and then asking why the fire is expanding. This is not good news. And remember, these are the projections prior to January of this year. So one would expect net, given the structure of the federal government spending plans, once we see a full budget for FY26, that this is going to get worse. And we have to be careful because many budgets are crafted with very, very favorable macroeconomic conditions. So if those macroeconomic conditions deteriorate further, those net interest costs only accelerate. We also have to recognize things are somewhat different this time around. If we look at the blue line represents the change in U.S. Treasury yields before and after the first announced cut in a Federal Reserve cutting cycle. So the way to think about this is the Federal Reserve has increased interest rates, then they announce their first cut, and they start cutting discount rates. So one would expect, as you can see by the blue line and the red line, that prior to the announcement of action to lower the discount rate, Treasury yields start to decline, right? They're declining in anticipation of a cut. And then once the first cut in the discount rate happens, Treasury yields in the past have declined because they're expecting further cuts. This time around, what we have observed is that Treasury yields increased. And the spread is now approximately 100 basis points between the average of the past 4 cycles and the current cycle. This spread represents, I think, in a view of risk and uncertainty by Treasury traders now, that they are uncertain whether the Federal Reserve will be able to cut rates, even if job growth is slowing because of the impact of tariffs on prices. So the Federal Reserve is caught between the proverbial rock and the hard place, because it is ending up with, we need to potentially engage in looser monetary policy to stave off a recession, but we can't do that because we're expecting higher inflation because of hardening inflationary expectations of tariffs. Not the greatest position to be in. We also have to recognize, from our perspective in Virginia, we are in a particularly vulnerable position. This chart basically looks at median household income on the x-axis. It looks at the ratio of federal expenditures to revenues on the y-axis. So states in the upper left-hand quadrant are net recipient states. They get a lot more money from the federal government than they send to the federal government in terms of income and corporate taxes. States in the lower right quadrant are net donors. They send a lot more money from taxes than they receive. So you can see California, New Jersey are net donors, Mississippi, West Virginia, New Mexico are net recipients. And then you have the upper left-hand quadrant. The upper left-hand quadrant are states that are net recipients, but with higher than average median household income. So median household incomes in Virginia are higher than median household incomes for the United States. However, Virginia, you could see, is especially vulnerable because it is one of those states that has much more federal expenditures than revenues. And that's due to the large federal presence in Northern Virginia and the large federal national security presence here in Hampton Roads. So cuts to federal employment and federal spending are likely to significantly impact Northern Virginia. And we remain to be seen about the Department of Defense spending in Hampton Roads and what happens to that. So why is this important from the Virginia's perspective? You think about this from an intergovernmental perspective, and we look across Virginia. The counties in Virginia that are generating the most in income and corporate taxes for the state government in Richmond are located in Northern Virginia. And if you have significant downshifts in economic activity in those Northern Virginia counties, that will not only affect the property tax bases of those counties, but it's also going to affect state revenues as well. And what is now a state surplus and a state that looks fairly flush in funds could turn on a dime and be facing a significant deficit in the coming year. So this sort of highlights what I just talked about, that Virginia may be the epicenter of a recession in 2025. We have significant uncertainty with regards to tariff, federal employment, and spending policy. Most of the announcements that have been made are going to impact traffic through the border of Virginia in terms of tariffs, because China is our #1 trading offer. Also, changes in federal employment are going to impact Northern Virginia housing values and corporate activity as well, and contract activity as well. And so we just don't know what we don't know, but we have a pretty strong feeling, given our dependence upon the federal government, that changes in federal government policy and spending and employment and tariff policy are going to significantly squeeze the state from those two perspectives. The House and Senate budget resolutions, as they stand now, contain $4.5, if not more, trillion in new debt, and those are on very favorable macroeconomic conditions. The macroeconomic conditions worsen, then the deficits and debt are going to explode. And in other words, we're going to be looking at annual deficits well in excess of $2 trillion if we see the TCJA extended and additional corporate income tax cuts, and then we have a significant economic downturn. This continues to limit the Fed's ability to do anything. That's essentially what it boils down to. And of course, the rise of stagflation is a possibility on the horizon. So in the limited time I have remaining, I'm going to talk about one of the things we looked at in Virginia, and that's whether or not there's a value to a college education. Being a professor at Old Dominion University, I should stop at this slide and say yes, but we wanted to look at it. So one way to think about this is in 2022, about 1 in 5 college graduates in the United States found themselves earning less than the national median income for just high school graduates in the same graduating class year. So if you if you take an individual from a high school graduating class and they go to college, and another individual from that same graduating class doesn't go to college, 1 in 5 graduates of the same high school year will earn less than the person who doesn't go to college. And in Virginia, it's about 19.9%, roughly the same thing. So this is a concern because, for decades, it's been go to college, get a better job, increase your lifetime income, everybody succeeds. And we're seeing a growing sentiment that college may not be worth it, that individuals are coming out of college with debt, they're not gaining useful skills, and the parents are voting with their feet and saying, no, you're going to go learn a trade, you're going to go do something else. And of course, student loans are a factor too, that student loans have allowed colleges and universities to have a soft budget constraint and pass on increasing costs in terms of tuition and fees to students. So it brings up the question, is it still worth it? Well, so one of the things we looked at, and this is from the U.S. Department of Education data, is the percent of students in each university who are earning more than a high school graduate. So we have median high school earnings, we have median earnings from university. You can see in the United States, approximately 20% of students do not earn more than a high school graduate, 80% do. The Virginia public median is 83%. So for public universities in Virginia, on average, they perform better than in the United States. But there are universities that don't perform better than the US median. And so the question then becomes, is picking a university important? So let's go look at private universities. And in private universities, you see significantly worse performance for a number of universities relative to the US private median and the Virginia private median. So this is interesting, right? In the public universities in Virginia, the previous slide, the median for Virginia was higher than the median for the United States for public universities and colleges. That story flips when we look at private institutions, not private nonprofit institutions in Virginia. We have to be careful. These are private nonprofits. The private for-profit universities perform even worse. So what does it cost? Well, we can look at the costs of universities. We have that information. We have the data on their income post-graduation, and we can look at across private, not-for-profit, and public universities, their performance on income to cost ratios. And you could see most public universities outperform all the universities in Virginia in terms of earning more income than their cost, right? Your sort of return on investment. And so you could see, however, that the public universities outperform the median. Many private universities do not. These private universities cost more, and in some cases they don't generate the degrees and then the earnings downstream that allows students to earn sufficient amount of money to offset the cost of attending college. So the one way to think about this is very simply, if you're paying more from college than you're earning in income on average, the ROI is not above 1. That is a significant concern and to students entering and students exiting. But we also have to recognize that many colleges and universities have massive price differences between what students are quoted and what they actually pay. Here, what this slide basically says is that the discount from the published sticker price in Virginia for public universities and colleges is approximately 41%. That between in-house grants and other loans and federal financial assistance, there's a significant reduction in the cost of attendance relative to what is the sticker price. So this would be equivalent to walking on a car lot and seeing a car for $30,000, and the dealer says, well, really the price is, it's 40% less. It's not $30,000, it's really $18,000. And that would be amazing, but that really doesn't happen. But it's a normal matter for Virginia's colleges and universities. And it should not be surprising that some of the more well-known, higher-ranked universities in Virginia are able to discount their tuition and other costs less than more sort of open higher admit universities in Virginia. So as you slide down, you see that the sticker price reduction declines. And we see similar behavior for private colleges and universities as well. The tuition tends to be higher here, so there's more room to discount the costs of attendance. We also have to recognize that the discounts are related to the share of students receiving the federal loans. This is going to be a very sticky challenge points for public universities and private non-for-profit universities in Virginia because of the uncertainty surrounding federal loans, student loans, and Pell Grants. We just don't know what's going to be happening down the line. You could see that the Virginia median is about 61% of students receive some type of federal financial assistance. That federal financial assistance is typically related to admission rates. In other words, If you look at the vertical axis and you look at the student, if you look at the top two, main campus, William and Mary Washington, James Madison, right? The mid rates are definitely lower for those universities, more selective, tend to be from higher income families. And so as you slide down, you see public universities that tend to be higher admits, lower income families. And of course, we see similar behavior here that you see that higher cost, higher recognition universities, higher tuition universities tend to have lower federal financial assistance relative to smaller universities, et cetera, in Virginia. And I'm looking at the clock, so I'm kind of moving through this quick, and I apologize, but I think I spent too much time on macroeconomic conditions, but it was important. So we see the similar behavior in Pell Grants, and again, a distribution which suggests that it's important to understand the cost of financial assistance. I want to spend a little bit of time in the last two slides as I wrap up here. One of the things we recognize is that, yes, it matters where you go to college, but as important, if not more important, is what you study in college and university. And so the variation of earnings across majors may be actually higher than the variation in earnings across institutions. That if you attend the right university, right, you get admitted to an elite institution and you pick the wrong degree program, the costs in terms of earnings could be much more punitive than if you attend the lower ranked university with the right degree program. And you could see here that engineering programs out earn, for example, liberal arts, sciences, general studies, and humanities at all ends of the spectrum. And in fact, the earnings by year 10 are almost double. And business-related ones, and economics is in there, are significantly higher than liberal arts and studies and humanities as well. So there are significant costs to attending specific degree programs. So you might find yourself in an affordable college, but the wrong degree program, and then end up with lower earnings 10 years post-graduation. And if we look at the annual earnings by selected degree holders by selected majors, you can see that there's significant variation amongst those, and this is for Virginia Tech. This is the post-secondary employment outcomes data from the U.S. Census. It's available. You could go online and see it. It's very interesting. But it shows that you can earn significant amounts of money depending upon the degree program you pick. You pick the wrong degree program, and I say wrong from an earnings perspective, not wrong from personal perspective, and the cost can be $40,000 to $60,000 a year 10 years post graduation, which definitely lowers the ROI on coverage. So to wrap this up, this is definitely a signal of why we've seen the absolute number of college students falling. Not only is there an ongoing demographic cliff coming with the number of fewer high school students, but a lot of people are looking at this and saying it's just not worth it to attend college anymore. And we still have data that suggests that attending college increases your lifetime income more than high school graduate, but that's on average. We have to recognize that right now we're seeing approximately 1 in 5 individuals in Virginia and across the United States graduating from college and at 1, 5, and 10 years not earning the same amount as a high school degree in their graduating class on average. And so what's happening, one of the things we're starting to see is that colleges are signalers, right? That if you get into the UVA or Harvard or MIT, that admission process and graduating process gives you a post-graduation employment signal that you have acquired a set of skills, but you've been through a filtering process. And thus employers have to do a lot less work calling the job applicants, trying to find those that are well suited for those positions. It does not mean that you could graduate from anywhere and go anywhere. It just means that if you have come from a higher income family, a higher wealth family, and use that to get into a more prestigious institution, you get a stronger signal to employers that at least get you into the first job, and then it's upon you. So that sort of wraps where I am up today. These are our upcoming presentations and reports that are coming out. Again, I'd like to thank Remy for inviting me to talk today. And I'm happy to stay online to answer any questions.
Excellent. Thank you very much, Bob. I think there right now don't appear to be any questions, and we are at time. If there are folks who have questions going forward, please feel free to reach out to Remy. You'll be receiving an email, I believe, in about an hour or so with the recording and the slides. So please feel free to respond to that or to info@remy.com, and we'll be happy to follow up with you. So thanks again to Bob for a great presentation, very informative. Thank you everyone for attending.
Thank you all.
Thank you, everybody.